of you to this webinar organized by Faculty of Management Studies, MBA department. Today's our session in for webinar that is on COVID-19 and banking sector. And we are having with
disconnect ಮಾಡಿದ್ನಿ ಏನು ಕೇಳಿಸ್ಕೊಳ್ತ ಮಾತಾಡ್ಲಿಕ್ತಾರಲ್ಲ.
Hello.
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 Yeah. Can I start? How it is?
Yes. Sorry, it was disconnected. So we welcome you, Jain sir. You can start your session in area of this banking sector, and you can give a brief guidelines to our all management students that what are the challenges and opportunities during this COVID-19. I would like to congratulate Divang sir also for this organizing such a wonderful webinar during this time period. That is a real requirement during COVID-19, that how certain challenges that will be faced and how to overcome that challenges.
Thank you,
Thank
madam.
you all. Sir, you can start your session.
Okay, ma'am. Okay, ma'am. Okay. At the outset, I thank you all the management, MBA faculty as well as the management for giving me an opportunity. I warm welcome to all the students. Just as a thought, when you say the bank, what do you remember, or what is the picture you will get into your mind? The bank means that. When I was a kid, I used to have a lot of people around my house who are working for the bank and used to come there, and I have interacted with them. So while growing up, I used to see them. And even in the, if you are all aware of that, if you have seen the old movies wherein bank employee working in the bank then comes in the evening to the home dots at 5 o'clock, then he gives the tiffin box to wife, and wife welcomes, greets her at the doorstep. There's quite a rosy picture, and kind of everybody. When I used to grow at the growing ages, I used to feel that the banking job is quite a romantic one. But when I joined, actually it's not. So that's how it went on. So when the Divyan sir asked me to give some this one discussions on the COVID-19 and banking sector, I was just thinking of banking sector and the COVID. Moving on this topic, COVID-19, as you know, we have a lot of discussions on the COVID. You would have also checked with the media, electronic media, and all. But as a bank has been evolved from the barter to the mortgage. What is a barter system? Give and take, simple. Whatever you give one You give one uh, item and you take from other item. That is from that to evolution of the money, and from the money to the lending to the finally to the property mortgage. So the banking has come a long way from the barter system to the mortgage. So in a typical bank, we have two kinds. One is advances and deposits. So advances is asset to the bank, deposits are liability to the bank. So advances is nothing but the lending, and the deposits is the collection of the money from the public. So that's why bankers are the authority who takes care of the public money. So brands again, what we are all looking into there are different types of banking systems, branch banking, digital banking, and we are also looking into the future of the banking in India. So these are all what topics we would like to cover in today's session. So next, going to the pre-COVID condition of what was the condition of the banking system or banking industry in India before COVID. Actually, the pandemic has started. The Indian banks are undercapitalized. They are undercapitalized. NPA crisis were there. If you remember, whenever I say undercapitalized or NPA or defaulter, then you suddenly will get some names, big names which are all there, including Ambani to Malia to Nirav Modi kind of a thing. So these are all wherein bank has lost money. Then the crisis have been there. They have got into the NPAs. So this what has happened is this actually cut down on the capital of the bank. So most of the banks were undercapitalized, and 70% of the banking share is with the public sector banks. So total banks out of 54 banks or something, 70% of the banking share is with the public sector banks, because we have culture of the nationalized bank and scheduled banks. So nationalized banks have, obviously, because of the kind of the advantage they had with the government and all, they have spread across the country, and there till today the share market share is higher. Then the last year credit growth, 2019 credit growth for the entire banking industry as a banking system was 6.13%, and the deposits grew by 11.0%. Out of which this credit growth, PSU banks have grown around only 5%. And NPBs, that is new private sector banks, new generation private sector banks, they have grown at a 25%, a whooping 25%. So that is a commendable by the NPBs compared to that of the PSUs. So, but PSU growing at 5% with a 70% of the market share is still a big chunk of the total market share. So NPBs have to do the lot of catching up to come to the near to the PSU banks in terms of the credit growth and all. Return on asset employed for the last year was a negative for PSUs, and for the new private sector banks, it was around 1 to 1.5%. So the return on assets employed, whatever the assets they have employed, it was negative for the PSUs, whereas for the new private sector banks, it is 1 to 1.5%. Again, return on equity was negative by 25% in PSUs and positive by 15% for the NPPs. So gross NPAs at 44% for PSUs and 2% for new generation private sector banks, and net NPAs at 2% for the NPVs. As per the National Economic Survey, out of 54 banks, 28 of them have the gross NPAs more than the capital adequacy ratio. That is, actually, they are negative, having a negative capital. They don't have a capital to lend further. So this is a situation. This was a situation in 2019 also. So capital adequacy ratio is nothing but the capital deployed by the bank divided by the risky assets. What is the risk weighted average of the we calculate, and based on that, capital adequacy ratio as per the RBI norm, it should be somewhere around about 12%, 11% kind of a thing. Most of the NPBs, new generation private sector banks, the capital adequacy ratio is at around 15 to 16%, and for the PSUs, it is at 11 to 12%. Then after this pandemic has hit, so this was a situation before pandemic. So banks are already in a stressed situation where the capitals were eroded and the NPAs was growing up. In such a situation, we had a pandemic in the form of a COVID, coronavirus disease 19. So that what happened is the COVID has actually taken out everything from the normal life of an individual to the manufacturing or whatever it may be. All have been halted, come to the stop. So lockdown, then subsequent measures and all. So this has impacted the entire system, entire economy, more so with the banking industry. So RBI has given some relief measures. So RBI has released some long-term repo auctions, done the long-term repo auctions of 100,000 crores to infuse the liquidity into the system so that the day-to-day activities, somebody wants to withdraw the deposit, somebody wants to take a loan, lending kind of a thing, that should not be affected. So liquidity infusion has happened from the RBI. Further, CRR cash reserve ratio has been brought down from 3% to the 4% by the RBI. So this is all kind of a thing wherein again they have also reduced the daily CRR balance, reduced from 90% to 80%, and repo rates have been cut 5.1% to 4%. But after all doing all this, it's not adequate for the kind of the economy what we are having. But these are the measures which are at least to sustain and survive, help the banks to lend further and at least do their day-to-day businesses has been helped. So impact of lending, the total lending has been divided into various segments. So services, lending to the services segment by the entire banking industry or the banking sector in India is at around 27%. Services include all kind of IT, ITIS, traders, then any kind of a consultancy. These are all fall into the services sector. Whereas industry, it includes the manufacturing, basically. So this constitutes the lending to the industry constitutes to be 32%, and lending to the retail is at around 28%, and agriculture and food industries is around 13% lending for the. This is what if I divide the total lending into the various segments, this is how it looks. Further, the impact also on the sectors, actually when you take for the industry where there is a 32% lending is there, in that if I drill deep into that, in the industry segment which is affected more in the COVID lockdown and COVID moratorium period, because one is the employment where no employees will run the factory and it cannot be run on auto mode or online kind of a thing. So it has affected more. Within that, which are the sectors which have been affected more are to travel and tourism, auto and auto ancillary, construction and construction materials, consumer durables, except that of high-end TVs. So this is quite an unprecedented kind of a thing. Suddenly, because of people staying in the home and all, the demand for the high-end TVs and entertainment gadgets. So personal entertainment gadgets like the handheld devices like mobiles, laptops, then tabs have been increased properly. Home within home kind of a situation has arisen, wherein in a single house, if there are four people are there, four people will be seeing watching a different channels, different programs because of this kind of the technology as well as the entertainment industry evolved over a period of time. The services sector constitutes the 80% of the essential category, which falls under the essential category, day-to-day kind of a thing, includes the telecom and media. But the services sector where there is a stress is in the businesses which are dependent on the offices or the schools. So the stationery, for example, a stationery trader or the stationery manufacturer might come under stress because his dependencies on the office and schools which were closed, and all working from the work from home culture has not actually gelled well with the this kind of a sector. So services sector, but 80% of that is quite good. So agri and food based industry has not affected by the pandemic because it actually affected by the climatic changes. What is happening based on the weather, whether there is some kind of the heavy rain, no rain, climatic. It depends on the climatic situation. Drought is there or not. This based on that, the agri and food industry has will affect, but not by the pandemic. So, what are the measures taken by the banks to tide over such a situation? One is that of cost cutting measures. The cost cutting in terms of the so when people started working from the work from home culture has started, except that of the branches, most of the operations have been done through the work from home, given the remote access to the employees. And while doing so, the computers, the electricity, the telephone, which were there in the offices. Say there are 400 people sitting capacity office. Nobody is coming, and these bills are actually hitting. So all these cost cutting measures have been taken, wherein they have actually disconnected the all these connections for the telephones, electricity only for the one or two lines, kind of a thing they have done. These are the kind of cost cutting measures they have taken. Further, hiring has been freezed for all the banks. No hiring has happened. No increments, no bonuses. Even few of the banks have reduced the existing salaries, at least to the top management, and few banks even to the entire staff, up to the percentage of 5%. So to control costs, they have done, and no dividends have been declared, and some kind of a capital control by way of controlled lending only to the segments which are not affected or actually benefited by the COVID. So some of the segments like laptop manufacturers, laptop, and in fact that of the masks, sanitizers, who have been actually benefited out of the pandemic, they have been actually the lending has been focused on such a segments where the uh, it is not a risky and it is considered as the money is safe. So such kind of segments have been considered. Uh, Then what are the credit measures taken during this period was lending to the only quality assets. Lending was not stopped, lending was there, but only based on the quality assets. So quality assets means if the balance sheet is healthy, even during the pandemic, if we take their GST returns and all, if you see the turnovers are happening, maybe first month, that is in the month of April, there might not be, which was a fully lockdown period where there is no sales would have been there. But subsequent months, it started, and slowly, if you kind of some sales is there, something is there. Then based on that, taking the GST returns of the companies, actually bankers have started and looking into that deep into that, and whether the sustainable, and again the segment matters. So that all based on that, lending for the quality assets have been started. Next, while assessing a customer, so normally this is standard wherein willingness to pay and ability to pay what we check. This has been actually, we used to have kind of a, okay, this is one of the thing we'll visit and see. Now it has become topmost priority, willingness to pay and ability to pay. Now we started asking for the other sources of the income, from where he is going to get, whether there is a rental income, whether there is the agri income. So while assessing a file, we all started getting into the more deep into the ability to pay and willingness to pay. So during the COVID and situation and all, even government has brought in a lot of measures. RBI has given some relaxations. There will be people who would like to take advantage and not to pay. So that again we have to assess, go deep into that, well into that. Probably we would have been preferred to give the money or the lending or the loan to the existing customer who is having with us for last 4 years, 5 years, 10 years kind of a thing, rather than giving it to the new. So to find a new customer even during the pandemic was a difficulty, and the relationship was not established. We are not able to find out this whether the genuinity of the customer. So, to kind of a thing, first quarter, actually, we have not scouted for the new business. So, we have only focused on the existing business and expansion based on the existing business. Next, collateral backed lending. Earlier, quite a sufficient portion of our lending book was unsecured. So now pandemic has taught us now this is not going to work. So it's all now only secured asset backed lending what we were doing it. So even there is percentage wise security is less, but cash flows are good. We are still looking into such kind of proposals. We are doing it, but secured assets is what is preferred. Earlier, we used to have the unsecured kind, even at the 10%, 20% kind of a collateral we used to do. That has all stopped now. It is anything above 70% and that above that kind of a collateral, we are looking into that. So sufficiently our loans have been covered by the collateral. That is what we are looking into the while lending the customers. Increased debtor days and decreased stock levels. So this has happened in the first 2-3 months. While customer has to submit every month his stock statement whenever there is a loans or the working capital loan more than the more than the 2 crores or so, like that. We started observing that there is no recovery happening. Stock levels are depleting. No sales is there. Yeah, this is obviously because there is no transportation. Stocks were not coming. Debtors were not paying, and debtor cycles are elongated at these few cases. Debtors more than 180 days is going up. Debtors more than 180 days, we need to adjust it into the capital. That is one more issue. So to avoid all that, and this also led to the reduced drawing power for the customer. So reduced drawing power means one is customer needs money at this point of time, which is very situation is not good. So here customer has a fixed expenses like rent, salary, then to the some of the suppliers wherein he would have committed earlier that I will be paying, that payments have come due. He has to make that payments immediately. Then some statutory payments which are maybe that have been deferred for a while, but at least certain fixed cost he needs to cover. So few of the cases, instances, the drawing power for the customer itself is not covering his expenses and all. So then, as a bank or a banking sector, as the RBI has given instructions to look into the this elongated drawing power. While calculating drawing power, we used to take the stocks plus debtors minus creditors, and 25% of this we will consider as the drawing power. So now this margin of 25% has been reduced to the in some cases at 10%. Then while calculating the debtors up to 90 days we used to calculate. that has been increased to 120 days or 150 days based on the customer requirement and genuinity. What that has been changed, altered, and we have taken required approvals, and till such time where the normalcy restored, this kind of the adjustments have been made, and allowed to draw the money to the extent we have been sanctioned the limits. So this was one of the measures what we have taken, and this also helped us reclassification of NPAs by central bank. Central bank has allowed us not to consider the whatever the overdues, non-payment during this pandemic till September, that cannot be considered, or else we have to do the report to the credit bureau every month. What are the customers who are not paid back, who are overdues, who are having overdues, and all. So this reclassification of NPAs also helped us. Means this 6 months period, the payment, if it is not come, so that account is not becoming NPA, is one of the relief measure which was given by the government as well as the RBI, has helped customers as well as the banks to actually help the customers. Other relief measures by the RBI are moratorium for all the loans, as all of us know, whether it is the housing loan, credit card outstanding, working capital, or the any term loan, any kind of a loan. It is not only to the banks, specific to the banks, NBFCs, all member lending institutions. They call it as member lending institutions. So whoever has lent, including the this micro or microfinancial institutions and all. So there the moratorium has given, the customer was given a relief not to pay his EMI up till September, and that will be adjusted in the next month. So that has given some kind of the way out for the people who are where the businesses have been hit. Then COVID dispensations like a reduction in debtor margin that I have already explained, increasing the debtor days. This kind of dispensations has also helped the customers. Government has also given one ECLG scheme, that is Emergency Credit Lending Guarantee Scheme. It means whatever the outstanding of a customer as on 29th of February to 2020, that outstanding of 20% of that outstanding you can give as a ECLG. For that, government gives the guarantee. So this also helped the most of the COVID-ridden companies to come out from their fixed expenses problems, or the kind of that we have lent. Banks went ahead and given it to the all the customers who are eligible. Earlier it was the up to 100 crores turnover kind of a companies. Now it has been increased to 250 crores of the kind of a company. Wherever eligible customers are there, so government is giving it helping the customer, and 100% guaranteed by the government. So this is going then, and this is for the 4 years period, and first year only interest serving is there. There is no EMI kind of a thing. Customer has to pay only the interest, and next 36 months he has to pay the EMI for the amount which has been lent. Further, to ease out, after 6 months over, September 30th or the first, August 31st, as they are the 1st of September, lot of the moratorium is over. A lot of customers will suddenly get the interest debit in their account to the extent of 20 lakhs, 30 lakhs, and arranging that kind of funds is difficult for them. So again, RBI has asked the banks to give the fund-based interest term loan, so that whatever interest has been accrued will be considered as one term loan, and then this will be paid within till 31st of March 2021 monthly basis. So that is FITL, fund-based interest term loan. So This is to help customers to pay back the interest over a period of time and not one shot. This is the side of the till this we have discussed on the lending part of the banking, how it has been evolved during the COVID, and what are the measures have been taken. Now there is other side is also the liability. The branch banking, basically the function of the branch banking is to get the deposits from the customers, that is low cost deposits, CASA, then demand deposits for help the bank to get the low cost funds to deploy to the earn interest, higher interest at the loans. So branch banking suddenly after pandemic, uh, it is all work from home culture has started, but certain transactions cannot be done from the work from home. Some documents verification documents need to be submitted. So there should be a staff in the bank which can check all these things, or some corporate comes and asks for make a RTGS, make a transaction, give the check. So these are all the things which are not possible from work from home. So what we have done, or the banking per se across country has done, is they deployed their skeletal staff. Maybe around 30% of the staff on an alternative day basis used to come to the branch, work from the branch with all precautions taken. Probably you would have been seen videos or the even into the this our mass media as well as social media. We have seen some customer has come to the bank at the cashier point. Cashier gives the cashier puts the sanitizer into his hand. Customer considers it as a tirtha and drinks. So all kind of such situations also happen, but the precautions have been adequately taken during this period with the skeletal staff working at the branches. And then slowly banks also realized it is a time for go for the digitalization. So new private sector banks have already started adoption of the digitalization long back, so they were quite comfortable. But some of the PSUs forced to take this step, so they need to go on for the this digitalization. So they have started. So again, the digitalization adoption rate also increased during this period to 60%, which is expected to increase up to 80%. It might not be a possible for 100% adoption for the digitalization in the banking. As given earlier, I said it to you that some of the transactions wherein documentation is required to be handled, verified, so that cannot be done. Second one is that we have a quite a big chunk of rural mass, unbanked mass is there, unbanked cities are there. So there, even telecom industry or internet connectivity is not sufficient. In such a situations, adoption to the digitalization to 100% is not possible, which can be increased up to 80%. Even some of the senior citizens, old population who are not adequately happy with the digitalization, they still feel that personal touch has to be there. So they would like to come to the bank, have a chat with the bank employee, then share some their day-to-day activities, discuss something, and then go. That kind of a population is also there. So considering that the digitalization up to 100% is difficult to ask as of now, so we can increase it up to 80%. Then segmented approach for the digital adoption. 20 to 30% of the branch banking staff had come. This I already addressed. Older generation. So mobilization of deposits has taken a first step into the during this pandemic. Rather than lending, so mobilization of the deposits was the priority for all the banks, which was there because so once the low cost funds are with the bank, when the pandemic is over, the situation is normal. And when we assess the situation, when we want to deploy to the money to the certain segments which are doing well, at that point of time, we should be adequately liquidation has to be there, adequate liquidation, so that so it which is better than which the CASA and FTA which are the best kind of a thing wherein the low cost deposits we can attract, and most of the banks went again in a steer to mobilizing of the low cost deposits. Future of the banking. The banking future is, as I already discussed, it is mostly the digitalization. New generation is adapting very well, and mostly it is bank from home for kind for the new generation. They are all well equipped. Probably Google Pay and all only available in India. This US, such a advanced country, Google Pay is not there. It doesn't work. So such is the kind of love and affection towards the technology from the new generation, that is the young generation in India. So Google Pay kind of UPIs, DMAT, they are all using it, and probably they have actually the use of these kind of UPIs have been increased during this pandemic. This is one of the thing. Next, renewed risk assessment models. So while lending, the risk assessment model what we used to have, the credit bureau only, or depending on the how to find out the customer's history. It's mostly based on the history. So CIBIL report, SMA report, that we used to see. Now that is not sufficient. We need to go a little further. We have to find it out with the suppliers, whether the payments are happening on time. So whether this we have to find it out with the customers of the company, whether the supply is proper with this. So if supply is proper means manufacturing is happening proper, means the liquidity is not an issue with the company. So we have to assess the risk of the lending a little more cautious, and the traditional risk assessment is not sufficient going forward. So we need to deep delve into the risk assessment models. In fact, we have to ask the peers in the same category how is this business is doing and all. So more of the local assessment which needs to be done rather than the history. History might be good. Future is bit of difficult ask now. So even including the industry assessment, we need to do deep into this because which industry is operating. So that all gems and jewelry again, we don't know. The suddenly stock market falls, gems and jewelry prices goes up. So once the stock market starts picking, then gems and jewelry will come down. So if you have lend some gold metal loan for 5 crores, 10 crores to the some of the gems and jewelry, and his mark to market has gone up, and he has to bring in money. From where he will bring in? So these kind of assessments needs to be done industry specific. So this needs to be changed and looked into deeperly. Then interest rate probably because of the measures what RBI has taken, so a lot of interest have come down. So it may change over a period of time. Interest rate may go up, but interest rate is important because of the profitability of the bank and to sustainability of the bank. Bank is already with low business or no business kind of a situation. So if the some deals which are not uh, profitable, then probably banks need to go let go kind of a situation is there. With further reduction in interest rate and no margins is a difficult situation going forward. So banking sector is looking at the stable interest rate kind of regime or increased interest rate of a regime going forward. then something known as banks also need to have the social capital. Social capital means unlike olden days, now it is bank is also a part of the society. So bank has to give back to the society. So something they have to start doing some PR kind of exercise with the society. So they need to give back and actually gain a trust of the customers when it comes, because all banking products are the same, which can be copied easily, which can the competition is, you cannot beat any competition based on the interest rate or the product differentiation, because it is easily copied. So only way is either your relationship with the bank or the social capital kind of a thing, wherein customers started feeling that, oh, this bank is good, they are doing this work and that, so we should go with this bank of kind. So need all the banks to get into this space sooner or later, so that if not, the ecosystem itself is forces them to get into that. So final words: Indian economy grows by local demand, and banking sector needs to support the growth. Unlike the other economy, wherein foreign economies, if you take, so the demand is very low. For India, given the kind of a population, the local demand is very high. They need not depend on the foreign markets. So they can start, and the declining of the China in terms of the manufacturing hub, most of the US manufacturers would like to get out from the China, which is a big opportunity for the Indian manufacturers. Maybe government is also started based on this Atmanirbhar Bharat and kind of a campaign and all. These are all going to help in the SME segment, as well as the manufacturers from the foreign investors as well. They can invest more. The future is quite bright in this space. While GDP as something is grows at 6%, 5%, banking growth will be somewhere around 20 to 25%. So this is where the effect of the COVID and banking on the banking segment. So I am done with the presentation. Any questions, please?
Thank you, sir. It was really like a very informative session, and uh, I would like to summarize what you have explained to us. That is you started with the current status of banking, so and you summarized that it is impact a little bit, but later on, like it is expected to be definitely with a 20 to 25% growth. So the end with the positive note. So it says about your detailed study about the banking sector. So your major focus was on lending to service, industry, retail, agri, and food status. You also focus on a package of government to release liquidity and how it was impacted. It was also like impact of COVID in different sectors. You have also accommodate and explain the things, and how the banks right now measuring take a measurement to cutting the cost and also managing their clients, providing better services, and also manage the employees, and how the corporates are facing the problem with respect to short-term funds and the long-term and the liquidity. And the content was very rich. And now I open the session for question and answer. So we are having a Nirav Jingar. He's our MBA Finance B student, and the all the question and answer is diverted to him, and he will ask the question on behalf of the student, sir. Yeah. So
Okay.
Nirav, it is up to you.
Good afternoon, sir.
Very good afternoon.
Sir, the one question is how cost cutting impact on a fresh MBA students who their career in the banking sectors.
Career in the banking sector, whether it is COVID or non-COVID. Yeah, first thing is one thing we have to see is the skill set what is required from the banking sector as of now or in the future. It's all on the skill set and the need. So irrespective of what you are saying is, as of now, the employment is freeze and all. It is hardly a quarter phenomenon of a 1 quarter or maybe 2 quarters. Come March, again, fresh hirings will start, fresh businesses will start. So there is an ample opportunity. As I told you, the sector will grow at 20 to 25% on year-on-year basis. It needs a lot of employment is there. But thing is that, are we ready to grab this opportunity? This is my only humble request to all the MBA students. If you would like to have a career in the banking sector, first study the need of the banking sector. So even for the if you are the loans also becoming digital, so techno savvy, then you may do your project somewhere in some one of the banks rather than going for the company for your annual projects and all. Yeah, there is definitely a ample of opportunity, abundant opportunities are there. But the only thing is that we need to fit ourselves into the that kind of category of that. So we should show the our industry domain expertise to the hirer. So it is very smooth hiring then.
Sure, sir. Sir, one more question. Hello.
Yeah, please go ahead.
Sir, about the recent issue about the Yes Bank and SBI interference, where you see as a Yes Bank after 5 years.
No, I didn't get your question. Would you please come back again?
Yes, sir. Sir, what is the recent issue about the Yes Bank and SBI interference, where you see the Yes Bank after 5 years?
Yeah, you have asked a question which needs a long explanation, but anyway, I'll just cut it short. Yes Bank has get into the problems because of the increased NPS. Maybe bigger lenders like Anil Ambani Group, ADGI, then even to the G, even to the few of the customers wherein the recovery, including the Cafe Coffee Day, Siddharth and all. So wherein recovery didn't happen, lending was there, exposures to the corporate side was very high. And if you see the total group of book of the Yes Bank, out of 3,000 crores of lending, it is almost 70% was lending to the corporates. One corporate gone bust. It is almost sometimes like Anil Ambani Group. It is 10,000 crores gone into the drain. So this was actually a mistake or maybe a focused wrong approach by the bank in the earlier regime, wherein putting all the eggs into the single basket kind of a thing. That has led to the problem. So then the capital adequacy ratio fall down, deposits eroded. So we were not able to honor some of the commitments. Then this all started. People have started of India. Yeah, they have come out so that because bank of this size cannot go down. So they have with the consortium of all the bankers. Again, it is public-private kind of a thing, wherein led by the SBI infused the funds. And recently also we have raised the follow-up of share options up to 12,000 crores, 15,000 crores to be precise. So which has all helped us actually. Now the issues have been sorted out and has been supported by the best bank in the industry, SBI. So this mistake what we had been done in the earlier regime is being sorted out. Now it is the focus is the tilted approach now is we have to lend 70% of our book to the retail. In the retail segment, what happens is it is a risk spread. Suppose my maximum exposure for one of the customers will be somewhere around 50 crores kind of a thing, rather than 10,000 crores. So even 50 crores plus, it's a quite an adjustable kind of a figure. So instead of putting all eggs in a single basket and then getting trouble into that, we have changed that model. So new MD, Mr. Prashant Kumar, who is from again SBI. So this we have a clear mandate now. It is only retail focus. So going forward, probably the best place to work is Yes Bank, because the future is very high, and it is supported by the one of the best in the banking industry, top bank. And you will have the private sector, unlike the jittery of the nationalized bank and all. You have the combination of private sector bank as well as the public sector bank. So that's what I feel.
Thank you, sir. One more questions about how FMCG and consumer durable sector will move during this pandemic situation, because FMCG sector right now grow very lower rate, especially short term, but they also consumers spend less consumptions in the consumer durable goods. So how they move in the futures?
FMCG was never a problem with. FMCG is not because of the pandemic. So because your day-to-day items, you need to procure it. It's not that maybe probably some of the food items you might defer to buy, but it is.
Hello. Hello.
Yes, sir.
I think Subodh sir is sorry, Jayan sir is disconnected. Hello,
Yes, sir.
Jayan sir, are you there? Hello.
Oh, yeah. Am I audible?
Yeah, yes, sir.
Yes, sir.
You're audible.
Where was that we disconnected?
FMCG. I think you are talking on FMCG sector. I think you answered the question. Neither, do you have any other question?
No, sir.
Okay, so sir, I have one question. That is one of from my student.
Okay, sir.
Here's the question, that as interest rates are low, inflation is increased, and the people are not getting job right now. So people will withdraw money from the banks to cover up their expenses, and as a result, bank will not have appropriate cash flow. And let's say some of the loan given to SME sectors and SMS, that is a small medium enterprise sectors, defaults, and they are defaulting. So how the bank, as a Yes Bank, you will deal with such situation, and will NPA increase, and will it make banks fundamentals weak? Yes or no, like this. This is a question from one of the student.
No, I didn't get the last part of the question. Would you please repeat again?
Yeah, sir. He is like focus that, like, if because interest rate is also going down and people are withdrawing money from the banks, and also as per the government insists, so they are providing loans to SME sectors. So how as a Yes Bank you are going to deal with this situation? So this is the one question. And another question is, will NPA increase? And if it is increased, then but obvious how it is going to impact to the banks? So that is a question, sir.
First question, interest rate coming down and SME segment. So the future for any bank is SME space only, because the lending is it's not at the huge kind of a lending. Lending will be somewhere around 20 crores, 30 crores, 50 crores, maximum of 60, 80 or 100 crores kind of a thing. So And the risk assessment model I have said that needs to be addressed. If something already we have funded and that goes into the bust because of the pandemic, yes, then probably we are expecting some relief measures from the RBI also in such a situation, so which is not yet rolled out. Probably few of the measures wherein NPA relaxation on the NPA consideration, the payment not done, now it is considered 90 days, it's there, which may take little further or whatever. So that is what is expected. Probably if nothing happens, then some hit will come onto the banking sector. NPAs are going to raise, at least for the short term, it is going to raise. Then we need to deal with it. As of now, currently, if you say particularly as bank, yes, we have adequately taken care of that. The fundraising has happened 15,000 crores, and this is sufficient for us in increased NPA or non-increased NPA at least for next 3 years. So we have taken care of that kind of a situation also. But it is expected to increase some kind of NPAs, especially in the industry wherein the manufacturing has not auto ancillary kind of a thing, construction. So we are expected it.
Yes, sir. Thank you, sir. Nirav, did you get any other questions? Not, I didn't get any, because two questions you sir already deal with. Because one of the question was related with the economy impact and the RBI steps, so you already covered the things. Nirav, did you have any questions?
So no questions.
Okay. So thank you, Jayan sir. We are concluding this session, and again I'm thanking you on behalf of Parul Institute of Management and Research, Parul University, for sparing your holiday and 1 hour for us. And I hope your rich content will definitely benefits to our students.
Thank you, sir. Thank you. It's my duty actually.
Thank you, sir, for sharing your valuable time and share the experience and help to all the students, MBA students.
Thank you very much. All the best for your all the future exams, and thank you very much, Divyank sir. All the best to you also.
Yes, sir. We'll talk in person also on the same.
Yeah? Thank you, sir. Thank you. Sir.
Okay, sir. Yes, okay, you may leave the meeting. Fine, sir. Jiten sir. Hello. Okay, Nirav, you may also leave. That's fine. I'll inform to Jiten sir to stop recording.
Divyank sir, is it possible for you to share this recording with me?
Yeah, fine. Yes, sir. I am going to share you not only your link and video. I'm also will share you the list of participants. Means like here we cannot see the all participants because it was live streamed. So the list of participants will also be available. So that I'll share you. Even your certificate of presentation will be there, sir.
Okay, sir. Thank you.
Okay.
Thank for Parul management, and thank you, sir.
Welcome, sir.